Andrew Holland joins us, Chief Investment Officer with Ambit Investment Advisors. He joins us live from his Mumbai office. Andrew, good morning and thank you for joining us.
Good morning.
Andrew, what do you want to start with? Infosys, pharma, or what's happening to India's gas policy?
Well, Infosys, I'll start with IT. I mean, Infosys came out with, a kind of in-line set of results, but obviously the body language and from the conference call was very positive. We think that the share price will continue to kind of forge ahead, but there's still a few things, I think we have to worry about. There's still a lot of management changes. They need to win some bigger contracts in the US, which, they haven't been doing. So, whilst I think the relief factor is there, I still go back to my kind of old favourite of Tech Mahindra and still feel that this is the one which will jump into the big league this year, since the merger, and will continue to forge ahead. So still like Tech Mahindra on a longer term view, but I think we're going to get the momentum in the sector continuing. So it remains one of our favourite defensive sectors, mainly because the US and Europe will start to show very strong growth. In terms of the gas pricing, good news, finally we get notification. What is still confusing, there's still a few things which need to be resolved in terms of what will happen on the fertilizer subsidies and so forth. And of course, the government can give with one hand and take from the other. So ONGC buying IOC stake doesn't really make any sense to me. So it's a sector which you always have government intervention, and so therefore when you look down at the fundamentals and say, right, there's something really we can start to get more excited about, the government come around and change the playing field. So I think I'd rather wait for this sector for the next few months and see how things settle down and what the government's intentions are, both with the stake sale of IOC and with their plans for the fertilizer subsidies. As regards pharma, I'm not really as kind of bullish on pharma as I was throughout 2013, and in fact, it's one of the sectors which were taking money off the table now and starting to put it more towards the cyclical sectors where we feel there's better value going forward.
Okay, that's the call coming in IT. ONGC, by the way, well, surprisingly, has had a good start in trade. The stock is holding up by about 2%, and IOC as well, 2.25% actually. And IOC as well is not looking all that bad. And like I said, we are the outperformers in the entire region, so to speak. A 1% higher tick coming in for the Nifty, and that I think has also got to do with the correlation in the strength in the currency this morning more than anything else. But of course, I did two key data points last week, and both have been at, extreme ends, the IIP as well as the trade deficit data. And today, of course, all eyes are going to be on WPI as well as CPI, which is going to be of utmost crucial.
Yeah, so the spin today is obviously, IIP means, the RBI is probably on hold, and if the CPI comes in anywhere, towards 10%, then I think we'll all be clamouring for an interest rate cut towards the end of January. I don't think that will happen. I think the RBI will stay on hold. I think it'd be a bit early to do anything with interest rates, either up or down at the moment. There's too many factors. I found that the RBI governor's changed the goalpost quite a number of times, so I'm not going to try and preempt what he's going to be thinking. But obviously, he's trying to keep growth there. That's for sure, because the last CPI figures were absolutely awful. So it's just put a bit more volatility into the markets. We'll all be, deciphering the data in terms of what the CPI means and whether he can afford to bring down interest rates. But for sure, I think there's two things from the data. One, there's a growth shock coming for the GDP, which gives him the comfort level of not having to increase interest rates. And that's our call now. We don't think interest rates will rise, but it won't be till the second half of 2014 that we'll start to see interest rates come down more markedly from where we are today.
And a lifetime high for Infosys. No surprises there really. We were just shy of that mark in any case in Friday's session. And now Infosys crossed past its previous high to make a fresh lifetime high for itself. Let's just bring up the chart for Infosys. Up in excess of 2.5% actually. And almost 250,000 shares traded already in just within minutes of opening bell. 2.6% higher. 3644 is where Infosys is at a fresh all-time high. Andrew, what's the sense after Infy's stupendous performance and of course a whole lot of, management positive commentary as well, NRN's, complete involvement in the management commentary as well this time. What's the sense that you're getting? What could one, expect from the likes of TCS or for that matter Tech Mahindra, which in any case have given strong performance the past quarters?
Yeah, I mean, obviously, Infosys had an increase in margins, which has obviously, helped their figures. I'm not expecting fireworks from any of these companies. I think, will be an inline quarter. I wouldn't extrapolate what Infosys did and say that's going to happen across the board. So, I'm not trying to, run ahead of these results. I think they'll be okay. I don't think they're going to be anything spectacular, that's for sure. So, great start. But I mean, if you look at IndusInd Bank's results, I mean, that would tell me that the banking sector remains under pressure. And we think the banking sector is going to be the sector which leads the index down over the next few months. We're concerned on a number of macro fronts outside of India. In terms of China, there's something happening there in terms of the markets telling us that the GDP growth is probably slowing more than we expected. I think, whilst the figures from the US on Friday in terms of jobs data was affected by weather conditions, I still expect the US to grow a lot quicker than consensus, and we could see tapering happening a lot quicker than people are anticipating right now. So, whilst we have some relief today in terms of the markets and the currency, expect that to reverse in the next few months.
Just coming to that point, Andrew, about IndusInd Bank. So you will not derive the connotation that perhaps the entire private bank would, also post in higher NPAs and NPLs. And do you think the PSU performance may be a tad better than expectation this time, purely on account of the run-up that we've seen in the PSU banking pack of late?
No, I think the run-up in the PSU banks was mainly on the back of expectations that they may pay higher dividends, because obviously the government needs money from anywhere it can get at the moment. It's not getting it from share sales, that's for sure. So that was the reason for the run-up in the PSU banks. I mean, you speak to any corporate, reality on the ground is that nothing's really changed. The markets might be higher, but business is still, extremely tough. And the banks really haven't made any significant headway in recovering or restructuring a lot of the loans which they need to do. So I expect the banking sector to really, show some poor results this time around. I think last time around it was a bit of a surprise on the upside, and I think we're going to be surprised on the downside this time. And I think IndusInd Banks is a lead indicator for that. So, banks would be a big short for us.
Let's not undermine the market action. Just when things were looking slightly rusty, Nifty was looking jammed, market breadth was not all that impressive. We got a nice little, party in large and mid-cap stocks. All three large IT stocks are trading at a record high, and this is big because the market capitalization for a TCS or Infosys is huge. So this is sheer market cap appreciation for large cap IT. The market breadth, which was negative on Friday, is looking powerful, at least for the moment. So you've got a ratio of about 2:7, and that's a very powerful ratio despite no big news trigger. Normally when you see such a big gap up start, such a strong market breadth, that is always propelled by a news trigger, either local or global. But for the moment, we don't have a trigger, and still markets are moving on. Andrew, the big concern for this market about 10 days ago was that in order to bridge the fiscal deficit, government would sell a lot of paper via the FPO route. But that concern for the moment has got arrested. Coal India will end up paying a fat dividend. IOC, well, ONGC will end up buying the stake in IOC. So do you think for the moment the liquidity equation is not going to be disturbed? There was a concern that if the liquidity equilibrium really shakes up, that will disturb the market?
Yeah, I mean, a lot of brokers came out and said that that would be a headwind for the markets. But my view is always this: it's a headwind for the markets if you want it to be a headwind for the markets. If you've got strong fundamentals, investors would lap up your shares. So the fact is that a lot of these companies, there's in terms of divestiture, we're really not the kind of clear favourites for FII investors going forward. So I think it's more of a sake of that. It's not really the right companies to be selling to bring in capital, rather than that the market was going to face some headwinds because of liquidity issues. Yeah, at the margin it does. But not really to the extent which I think a lot of people were talking about. It's never been one of the factors which we felt the markets would fall.